That's what the ice is for.
There, look at that. My hands are wet. All right, so let's go ahead and don't worry, we'll share. We'll share after. I thought it was me.
No, it is you.
Okay, it is. Cool. All right, so let's go ahead and jump on in. Give us a little bit of background about yourself, where you grew up, were your parents entrepreneurs, just kind of a few minutes on your backstory.
Yeah. I grew up in Syria. I was born and raised in Syria, and by now everybody knows where Syria is. 15 years ago, nobody knew where Syria is. I used to tell people where I was from. They're like, "Oh, is that Texas? Where's that?" Now, unfortunately, everybody knows where that is. Came to the States when I was 16, and my father was an entrepreneur. He left a cushy job and he opened his own law office, and that's where probably the entrepreneur blood came in the family. My brother, who is here, got the most entrepreneurial blood. My brother Tony. He's the maverick of the family.
Okay.
But we came to North Carolina initially when we first moved here, and that's where I went to undergrad. Went to UNC Charlotte, and then worked for a couple of years here in North Carolina, and then moved to Boston after a few years, and that's where I spent the last almost 18 years.
What brought you from after UNCC? What brought you up to Boston? Was it work?
Both work. I wanted to get my graduate degree. I wanted to get my MBA, and my sisters were up there. I had family up there, so it just seemed like it was right after the bubble crash of '99, and I was with a company who was manufacturing defense contract equipment, like missile launchers, and they didn't go out of business. It got bought out by a private equity company, and one of my friends said, "Why don't you just go to work for finance? It's such a growing industry." So that's why I moved to Boston. I went to work for Morgan Stanley, and I wanted to again get my MBA.
So when the company got acquired, did that kind of spark your interest? Like, oh shit, this company got bought. How can I kind of work into being the people who ends up buying companies?
Yeah, it did. It did. I didn't do that right away, but I wanted to kind of get my feet solid in corporate America first. So I worked in the corporate world for many years. And in 2004, 2005, I launched a company with a couple of partners from Morgan Stanley, a small consulting company that we did mixed-use development, large mixed-use development for apartments, hotels, hospitality. We had projects in Boston, Philadelphia, New York that we worked on. And that was really sort of what sparked my interest in doing a lot more on my own than just doing, obviously, corporate America.
So what was kind of that curve from going from corporate America, and what made you get into kind of real estate investing or consulting even, and started your own thing? Was there any fear? Were you still working at Morgan Stanley, or were you one of those entrepreneurs?
Yeah, no, it was actually a project that we worked on while I was at Morgan Stanley. We worked on a $1.3 billion project when I was at Morgan Stanley for this eccentric millionaire who was in Florida. He wanted to build this tallest residential tower in Key Biscayne at the time. And he wanted to house all the NAFTA offices on one level, and he wanted to house shops and 5-star luxury apartments and 5-star luxury hotels. And we worked on the project for about a year and a half, and didn't go anywhere. Morgan Stanley eventually funded some of it, but a lot of it ended up being a loss leader for them. But as a result of that project, we made connections with a bunch of people in New York and who are in the industry, and they contacted us offline and said, "Look, if you ever go on your own, we'd love to work with you. We have some projects in Miami and Philadelphia and in Boston that we'd love to work with you on." So we said, "Fuck that, let's go!" So that's what happened.
Nice. So what was that like, going from Morgan Stanley? You have one client at this time, I'm assuming.
Yeah.
So
yeah,
everything's
exactly.
in their lap. If they just cut ties with you, you're kind of fucked. Did that keep you up at night?
Yeah, it kept my wife up at night a lot. So a lot more than me probably, but yeah, it did keep me up at night. But it's a little easier when you have. I mean, I had a couple other partners, and it's easier when you know that you're working towards something, and you just wake up and you're like, you know, if I just put my 100% into it and try to make it happen, that's all I can do. I mean, I can't do anything more.
Yep.
The only fear is that what's outside of your control that you're not controlling, and that's the fear of any entrepreneur, I think, because we know where we control ourselves, but what we don't control is anybody else's expectation, everybody else's habits, and if that gets screwed up, then that's what kind of throws off the whole equation.
Okay.
So that's really the only fear is what anybody else is going to do, but as far as what you're going to do, you just wake up and you have to be comfortable with what you're doing, and hopefully it'll work. And it did work with us with a few projects. It worked with us until 2007, until the real estate took a shitter.
Yeah. So you jumped into tech when the market crashed there. Then you jumped into kind of real estate.
Finance,
So your timing sucks.
My timing sucks. My timing completely sucks. Yeah.
But you got through it and you learned a lot.
I did.
From that.
I did. Absolutely. I learned a ton. You got to learn. I look at everything as a learning experience.
Yeah.
Everything that we get into, you have to learn something out of it. One of my mentors in the industry said, "Look, if you wake up every day and you learn something out of every single day, then your day was worth it, no matter how little it was." And that's how I approach everything. I mean, really, if I can get into the office and get something, some soundbite or some tidbit out of what I've done during the day,
Waste a day.
then it's a great day. The only other way that you can't do that is if you just stay in bed all day. So,
Yeah.
which I've done before. But.
So you mentioned a mentor. I know there's a lot of entrepreneurs in here. Give us some advice on mentorship, because for me personally, I didn't have one until a few years ago, and because I was stubborn, and I'm sure there's stubborn people in here, like I can figure it out on my own. It doesn't work that way.
Yeah.
And can you attest to that, kind of, how you found your mentor, what you look for in one, and what other people should?
Yeah. So ironically, my first mentor was with Morgan Stanley. He was working for corporate America, but he was actually, ironically, a commercial fisherman before he went to work for Morgan Stanley.
Okay.
He had his own commercial fishing operation in Gloucester. He had a similar story as to what that movie The Perfect Storm had, where he had his own fishing boat, well-educated guy, but he just wanted to get into commercial fishing. And he operated his commercial fishing operation for 5-6 years, made a buttload of money, and during a storm similar to the movie Perfect Storm, crashed his boat, and a couple of his boatmates got killed, unfortunately, and he survived. And that's when he sold out of the business. And he said, I needed to do something else. I needed to do something more safe.
Yeah.
He had a lot of great little sort of wisdoms that I'm a learner by nature, and that's, I think, the first thing you have to be in order to grow in any business, especially if you're an entrepreneur. You have to open yourself to learning, because if you're not learning, then you're just not growing at all. Once you think you're the king shit, you know it all, that's when it's game's over.
Yeah.
So he to me presented a lot of the little sound bites that I needed at that time in my life. We all need mentors at different parts of our life, and they change, and it's okay for that, because you're growing beyond what you need at that point in life, and your mentors can grow with your evolution of your learning throughout your career.
Okay. So I always like to say I love being the dumbest person in the room, and I think that's kind of how it is with a mentor. Yeah.
Oh, absolutely. I always love being the dumbest person in the room, because if everybody else if I'm surrounded by people smarter than I am, then that means I'm learning something from them.
Yep. So you're with the consulting. You're doing the consulting stuff. What kind of happens after that? What happened with the company, or how did you exit that company?
Yeah, the company still. It went through a different iteration. It kind of got disbanded in 2006, 2007, got reformed in 2008, 2009, and at that time, My brother Tony had launched a multifamily business here in the Carolinas, and was starting to grow that business. And I kind of reformed a different company. I also kept my feet in corporate America at the time as well, and kind of did both. I did my own thing, my own company, and I worked for corporate America at the same time. I did institutional sales, institutional lending, all in the investment and finance realm. And a couple of years ago, it got to the point. Tony and I were talking for many years, and got to a point where we sort of needed to take the next evolution of the business and launch a private equity platform, launch a new fund. And it just couldn't be done with me being in Boston and him being here in North Carolina. So 2015, I made the decision that I'm going to move and join the business here full time, and that's what happened.
And who were you working with in Boston at that time when you left?
I was at that time. I was with bank.
Okay.
I was doing commercial banking at the time.
Okay.
My day job that paid the bills was commercial banking.
So how was that, I guess, leading up to it? You're talking to your wife, I'm assuming, like, look, I'm out of corporate America, I'm done. We're doing this on our own. I'm going to be a full-fledged entrepreneur. How was that transition? Did it keep you up at night? Did it keep her up at night? And kind of how'd you work through that?
It was a struggle. Even joining, an enterprise that with my brother, it's still a struggle to say, look, I need to decide whether I'm going to sink everything I have into this and make it successful and make it work. Because what we have is a family business. We, at the end of the day, our private equity platform, real estate platform, it's a family business. My brother, myself, my brother's daughters are in the business, my nieces. So if this doesn't work, it's a royal fuck up for everybody. So it's kind of scary and kind of nice to have that kind of responsibility. I thrive better under pressure.
Yep.
As do I think a lot of entrepreneurs. I do better under strict timeline. I do better under deadlines. I do better under certain pressures. I do better when something has to be delivered. I don't do well when something is loosey-goosey.
Yeah.
I just don't.
You have a year to finish this project that should take you a week. You're going to wait till the last week to start on it.
Exactly. And I think I share that with a lot of people that are of the same ilk. I think all of us, including you, I think we're all somewhat, we don't like last minute, but we perform better last minute.
Yep.
Because we know that something has to get done, has to get delivered, and we don't like to fail.
Yeah, exactly. So, all right. So you went into Boston Venture Partners. Can you tell us about how that started and what your role is with them? And
so Boston Venture Partners was the second iteration of my first firm that I started in 2004, which was called Brinkley, Hanane and Azar. This was the one we disbanded in 2006, 2007 when the market crashed. Boston Venture Partners started in 2008, and we still wanted to do real estate projects and real estate financing and development, but we also took on new clients in technology as well, and entertainment. So we had a company. One of our clients was a company that was trying to do develop a film studio out of a company that already exists that they did animation. They wanted to take their animation company and turn it into a major film studio that would get projects in major motion pictures. So we worked with them to actually get them financing for that, and they're still around. They're doing pretty fantastic stuff. They worked on a lot of blockbusters in the Boston area and in the New York area. Okay. So that's one client. We had another client that was in technology that wanted to also take his. He had a gaming startup, and he wanted to take his startup from the gaming platform that it was to something that could get spun out and bought out. So we kind of helped him through that transition of acquiring financing, acquiring equity financing, and look for beyond his seed round and A round, and kind of consult during that process as well.
Is that when you jumped in? Was in the seed round?
Yeah.
So you're
Yeah.
super early stage companies that you're dealing with.
Yeah. I mean, we at one point I also did the investment platform for a company called Net Capital in Boston. Net Capital is the company that was left over from Napster, if you remember what Napster
of course.
was. So
We got a lot of free music off there.
exactly. So John Fanning from Napster still is the eccentric founder of Net Capital, and he wanted to kind of establish a fund, and a really early stage fund, like a project idea based fund, and take it into something bigger. He wanted to grow it into $150 to $200 million enterprise, which is really hard to do for really early stage. Really early stage is very, very hard.
Ideas still on paper you're talking about,
Exactly,
pretty much. You're
exactly.
not even at your seed round.
Yeah, I mean, he had both the geography working for him and a lot of the people that he worked with, because we were based in Cambridge. We were based in the MIT area, so a lot of the projects that we worked on were MIT-based initiatives that were still on paper, but on paper at MIT. So on paper at MIT is a lot different than being on paper somewhere else.
Yeah.
So a couple of projects worked, a couple of projects didn't. He ended up moving his operation to the West Coast. I ended up staying East Coast, and that's where I'm at.
So when you're dealing, and actually I'm going to interrupt real quick. There's more beer over there since the kegs are tapped. I guess Circle K. Yeah, Circle K doesn't sell craft beer. We got to get the important.
Yeah, absolutely. Get the beers out of the way.
So when you're trying to secure capital for a seed round, or you're working with those companies trying to get them to secure capital so early stage, what are the investors and the companies that you're getting, or the individuals that are writing the checks, what are they looking for? From an investment standpoint, what's the biggest red flag, and what's the, like, okay, I love this guy, we're going to give him a shot?
So, we had to, so my job was actually speaking and interviewing the companies themselves, as well as expanding the investment platform, which is talking to investors. So I was in on the conversations when we were vetting the companies into our fund, as well as the other side, which is essentially the capital. The company, vetting the company, I mean, we really looked for, not just for ideas, but for the people behind the ideas. How committed are they?
Yeah.
What are they doing? What's their skin in the game in this? I mean, is this something that they just kind of came up with in a lab at MIT and they just wanted to sell this on napkin and walk away?
Yep.
Or did they really want to develop this idea and be all in? And, when I meet with people, with entrepreneurs at that time that had this kind of idea and that we contemplated funding them, my first question is, are you willing to give up your life for this?
Yeah.
And that was my first question, when I met with companies. And they said, I don't know. And I said, I'll say,
have a good day.
Have a good day. we'll part as friends. But because the answer to that question is what told me how committed they are to their company. Because that's really what you have to do. As a startup entrepreneur, you have to be committed to giving up your life for your company.
Yep.
At least the first few years
Yep.
of its growth, until you get it there.
Okay. So you still, that's company still active, Boston Venture Partners, right?
Yeah, that company's still active. We haven't really done anything. My other partners work with it. My time is 100% devoted to MACC Venture Partners, which is what the real estate platform that I'm working on now.
Yeah, and let's get into that. Why don't you tell us what you do with MACC and kind of what the vision is and what you and your brother and the rest of the family are doing?
Yeah, so it's a private equity real estate platform. We are owner operator of MultiFamily residential units. So we buy apartment complexes essentially, and commercial office spaces. We buy them all over the Southeast. We're Southeastern focused, so mostly North Carolina, South Carolina, Georgia, Florida, Texas. That's pretty much our core area. Our core area is really the Carolinas and Georgia. Is what we concentrate on. We pick up anything that's 100 unit plus, which means when we talk about units, meaning 100 apartment plus. Yep. And we look for, in our industry, what's known as value add. So we look for something that's kind of a disconnect, that has some kind of a disconnect to the marketplace, meaning either needing rehab or needing some kind of management play. There's got to be something that is causing this particular asset to have a disconnect to the rest of its market peers. Meaning if there's an apartment complex, 2 blocks down the road that is charging $30 in rent more, why is that apartment complex charging $30 more in rent for that same exact 1 bedroom than this one? So we love finding those because that's telling us there's some kind of a disconnect that we can hopefully fix, either by physical rehab or by human rehab.
Yep.
Meaning get rid of the management and put our management in.
Okay. So when you're doing something like that, I got a lot of questions because I don't know real estate or any of this shit. And I've told you that. We've had rooms before. Sunday night at your house, I was like, I'm lost. I know tech. I don't know any of this. So I guess the first thing is if you're going to just wipe out, you're saying if you're going to wipe out a staff, you're going to find your own people, you're going to interview them, you're going to hire them to put them into the complex.
Right. We have what's called a transition team in our company that their sole job and purpose is to really go into an apartment or an asset that we're acquiring and evaluate the team, the actual team that's in place there.
So you're interviewing them like, hey, you should keep your job. Why?
Exactly.
So you're the asshole who comes in.
Pretty much.
Yeah, okay.
I mean, we're pretty much the asshole. But again, it's another tenet of being having your own responsibility in your own companies. If you're not willing to be the asshole,
you can't run a business.
You can't run a business.
Yep.
So you have to be. You really have to be. We would like sometimes to keep the people in place and have continuity, but sometimes continuity is not good. Because sometimes the reason that the asset is cheap is because there's bad management. Mm-hmm. So that team really is responsible for the turnaround of that particular assets from a human standpoint.
Okay. And what's the price range that you guys usually, the sweet spot? Do you have a sweet spot as far as we'd like to look at units that cost over X amount but under X amount? Kind of how's that go?
Yeah, I mean we generally look for anything from about, I'd say, 10 million standpoint to 40 or 50 million. That's there's no sweet spot. That's really the range. 10 or 15 million, I would say maybe 20 million would be a sweet spot acquisition target.
Yep.
50 million would be on the higher end. That's the range that we operate in.
Okay.
I mean the apartment, the real estate business in general, especially commercial real estate business on at the private equity level. It's a very idiosyncratic business, meaning that each asset really has its own moving targets, have its own levers of profits, its own levers of loss, its own levers of bleeding profits or gaining profits. So you have to really look at each asset individually, not just via the marketplace. So, you have to obviously be in the right market as well. So we have to examine really 3 things when we look at an asset. We have to examine the market, we have to examine the economy, and we have to examine the asset itself. Very similar as to when I used to buy companies or fund companies. You have to really look at sort of the human element. You have to look at geography. You have to look at what the business is doing and what value it's bringing to sort of the economy or the economic structure.
So, as far as ROIs, return on investments, it's not going to be like tech where you're going to hit a Facebook where you're going to get 1,000x, I would imagine.
No
1,000x. Yeah. What are you targeting as far as returns on these? And I guess what's kind of industry standard when it comes to the commercial real estate side?
The returns that we target, it's the way we measure our returns is we measure returns for our investors.
Yep.
So the IRR that we get, the internal rate of return that we give our investors, and our cash on cash that we give our investors. Cash on cash, what's known in our business, is pretty much the interest rate or the coupon that our investors would get annually. Real estate, the good thing about especially the good thing about apartment investing is that it's a revenue generator both for us and for our investors. So when we buy an apartment complex, the revenue that's generated gets kicked out as distribution to our investors, which is how you make the coupon rate.
Okay.
So similar to like buying bonds. If you're buying and selling stocks and bonds, you have a similar concept to that. So a bond kicks out a certain coupon every year, or what would called coupon in that industry. Same thing with us. We kick out a certain coupon every year to our investors, as well as an IRR at the end of the cycle of our purchase. So
How long is that cycle?
the cycle is about 3 to 5 years is for us.
Pretty typical.
Yeah. The only thing about us is that it's not a liquid investment, so it's not like a stock. You can't buy into us and say, 6 months later say, I changed my mind, I'm out.
Yeah.
You can't.
It's like a traditional, any other venture capital fund. When
Yeah.
you're committed, you're committed.
Yeah, exactly. There are certain time commitments you have to do because really, and it's not because we want to be assholes about it. It's just because when we buy into an asset, it's hard to get money out of it unless you either sell it or find someone else to buy your private shares. We're not a publicly traded company. We're a private company where the project we sell are privately sold shares. So unless you find some other investor to buy your shares, there's really no way for you to get out. That's why it's illiquid.
So your investors, they have no say. You're not going to them. It's, again, like another VC fund. If you want to buy an apartment, you don't need to call up investor 1, 2, 3, 4, and 5 and say, hey, we want your feedback. It's a traditional fund. We're making the decisions. That's what you pay us to do.
Yeah, absolutely. I mean, we it's discretionary capital. It's called discretionary capital, which means when you invest, your money is, it's not silent per se, but you're what's called an LP partner, a limited partner. We are the JP, the general partner. So the general partner generally make most of the operating decision, and the limited partner get the benefit of the returns.
Yep.
So yeah, they don't play decisions in day-to-day operations. They don't decide. We don't go to our investors to say, hey, do you think we should hire this handyman or not hire this handyman, or replace this air conditioner or not replace this air conditioner? That would create mayhem.
Yeah.
So you have to run it that way. Otherwise, you can't make money for that.
So is your typical goal to flip these units that you buy? Is that what you're trying to do?
Sometimes it depends on the asset itself. Sometimes if the asset is bought at the right price, then our goal is to sometimes have a short hold, and our short hold is 2 years, 3 years.
Okay.
2 years considered a really short hold for us. Within 2 years, if we made our IRR expectation and we hit our target returns for our investors, then we sell out of the property.
And you're still currently on your first fund with this?
We're just launching our first fund now. Actually, the end of this month, hopefully our first fund launches. Before this fund, the way that we've done our acquisition is through what's called individual syndication, which means we would bring a project onto market and say, here's the project. It would be an actual asset, so an apartment complex. So let's say even this building. Say we're buying the HQ building. Here's the expected returns. Here are the expected cash on cash. Who's in, essentially, and we go to our stable of investors and see who would like to be in, and then we would obviously close on the sale and move on. The fund is a little bit different. It works similar to how most funds work. Essentially, it's still discretionary capital, meaning the investors in the fund will not have day-to-day say-so on what's going on or what we're acquiring. But what they will get is that they'll get the benefit of aggregated purchases or aggregated assets. So the fund will probably own, let's say, 20 apartment buildings, as opposed to just buying into one apartment building what we did before, individual acquisition.
So it's funny, my wife and I, who's sitting in the back, we were talking to Dan Roselli, who owns this building that we're sitting in, and he asked who was speaking. This was like 5:30, and I told him what you did, and he said that this is the hardest market to be in. And he said that buying HQ, although he loves it, it's one of the hardest, most stressful things. He thought it was going to be easy. So what's the secret sauce to do it? Because, I mean, he's had a lot of ups and downs, and we have Kevin here. I don't know where you are, Kevin, but There you are. From he owns Advent Co-working, another co-working space. So, what's the secret sauce when you're looking to, I guess more so from a commercial property, when you're looking to acquire? What's the best way to get your return on investment?
Yeah, co-working space is tough, and it's definitely a hot market. I mean, it's a hot market in Boston. It's a hot market in New York. I looked into a couple of different co-working assets about a year and a half ago, 2 years ago. It's a hot market. It's a very hot market, and it'll continue to be a hot market. But it's more difficult from the operator standpoint if you buy it and operate an asset than it is from an acquisition standpoint, which means for us. I mean, the stress that we have on our side of the business is who is the operator that's occupying our assets, our buildings. If it's a commercial office space, obviously the more stable that occupant is, the better for us.
Yeah.
But do we wake up stressing every day whether how good his business is doing? No. I mean, I hate to sound heartless, but all we care about is whether he's going to be able to pay his rent or not.
Yeah.
So but that's still stressful. I mean, because if a lot of times if you have a commercial office space and you have let's call it an anchor tenant that's occupying 50% of your property or 60% of your property, is sometimes even more. If that company folds or something happens to them, you're screwed.
Yeah.
I mean, it's not easy to replace. So that's really the stress for us. If we lose something like that, it's not like renting an apartment. You can't just flip it out in a week.
Have a waiting list. Yeah.
Exactly. Especially with larger buildings. I mean, larger the building is, the more stressful it is because you can't find someone every day that's going to rent 100,000 square feet. Or 50,000 square feet. I mean, that's an enormous company. You have to really go through. So the stress in our business is from that standpoint, not from the day-to-day operation of, whether, hey, did I bring in enough revenue into my building, such as HQ or anything like that. So it's a different stress, but it is nonetheless still stressful.
What do you see as being the next banging spot as far as growth?
Well, the hot market now is
besides
Raleigh.
Capstone.
Yeah, besides Capstone, yeah.
That's what you adjusted.
It's Raleigh is flaming hot right now. I mean, we can't ourselves touch anything in Raleigh just because the numbers don't work. Not because we want to buy in Raleigh more, but we look at the numbers and it's just they're just out of whack. The numbers everywhere right now are out of whack. I mean, we are at a cycle, unfortunately, where we believe we're at the top of a cycle. We don't know what that top looks like. It's not an angled curve where the curve is like that. It's more of a flat top curve where we know we're somewhere closer to the top, but we just don't know how long the flat part is going to go. The flat part could go for another 18 months, 24 months, 36 months. We really don't know. A lot of it is going to be dependent on what the migration from the apartment renters are going to be to single-family homes. Those logistics really affect our business. Obviously, the interest rates affect our business to some extent. The Fed interest rate, because that determines what the mortgage rates are going to be. Mortgage rates, in turn, somewhat affect our business. Ironically, the past couple of years, the mortgage rates have been really low, but apartment occupancy have been really high. So, we look at sometimes our business and go, what the
doesn't
fuck?
add up. Yeah,
it doesn't add up. Like you should be able to afford a home pretty easily from a mortgage standpoint. Yet in our business, especially younger, like millennials, really not gravitating yet towards home ownership. They're gravitating more towards a more nomadic, I would call it nomadic lifestyle, where they're renting apartments and changing cities, and that's probably why, where they don't want to be tethered to a home that they have to own and operate or anything like that. So that's a fair point, but that's really the only explanation I have, because on paper, from a financial standpoint, it makes more sense now to buy a home than ever. But hey, I'm not complaining because we're getting the benefit of more renters. But that cycle is, at some point, it will ebb, and then that's when you see some changes in the industry.
So I'm assuming if there's another crash like in 07, 08 for the housing market, that's going to make it harder for you to get these apartments just because a lot of people, more foreclosures, more apartments rented out, more revenues for them.
Yeah, so I don't think I don't think we're going to go, even when the market adjusts and we have a little bit of recapitalization in the market. I don't think we're going to go through what we went through in 2008. Liquidity is a lot higher now than it was in 2008. Banks are a lot more cautious than they were in 2008, even though there's still some questionable lending going on. But the dynamics in the marketplace in general are not the same as 2008. So when we have a correction or an adjustment in the market, I would be hesitant to say it's going to be a crash. It might be a soft slope down as opposed to a crash. Okay. But that could be good or bad for us. I mean, it could be good for us from a buyer standpoint because you'd want to buy during a downturn to some extent. Right now, it's a seller's market. Right now, everybody that owns similar assets that we do is, on high grounds. And that's why the numbers don't make sense to us, because when we look at financials and we spreadsheet an asset, we go, where are the profits? I mean, how can we make the income that we want to make to our investors by buying this asset? It just doesn't make sense. So doing a downturn, the numbers will start obviously being more deleterious to the sellers, and they'll be more beneficial for us.
Cool. Yeah. You want to talk about peak?
Peak? No.
Okay. That's for next time.
That's for next time.
All right.
Yeah.
So you've done some other investing, so you had a Capstone as well.
Yeah.
So why don't you explain with Capstone?
Well, Capstone is our sister company. Capstone is our essentially I said we're owner operators. So Capstone is our essentially operating arm for running all of our assets. MACC Venture Partners is essentially the capital arm and the acquisition arm and the money arm of the whole enterprise. Capstone is essentially the day-to-day operation of the apartments. They're the one who fire people.
Okay.
In the apartment complex.
So that way your name doesn't have to be as, I'm with MACC.
Exactly. I don't know what you're talking about. I'm sorry that happened to you.
That's that team over there.
Yeah, exactly.
So do you do any angel investing or anything? Have you considered that as far as more tech outside of?
Yeah, I mean, I personally did before, and it didn't work out so well. But we would certainly probably entertain it in the next couple of years. Hopefully, after we grow Fund 1, maybe Fund 2, we can probably look at doing something outside of the scope of what we currently do.
So you said it didn't go well. What did you learn from that? Because you said that there's no mistakes ever made. So there are mistakes. Mistakes, but they're learning experiences.
Oh, they're learning experiences. Oh,
yeah.
Absolutely. I think it's because for that particular situation, I invested because it was a friend.
Oh.
And
don't invest in friends. What do they call it? The 3 Fs: friends, family, and fools.
Exactly. Yeah. Exactly. That's why for us, when in our business, we really a lot of when we go to market, we really rely on investors outside of there's no such thing as friends and family investors for us, because we just don't want to put anybody in an awkward situation.
Yep.
Even though our investment is a lot safer than a lot of other investments out there. I mean, I love going head to head with someone who's comparing us to, an equity or Wall Street investment. I came from Wall Street in my background, so I love to talk about that. I love to talk about beta and alpha, because that's what they do. People who are heavily invested in equities and debt from a Wall Street perspective, they love to talk about that. So I can go head to head with them any day, because our beta or our risk is so much less than anything out there as far as stocks or even bonds. So I can always hands down sell over anybody who's trying to compare us to stocks and bonds.
Yeah, and you're talking stocks or bonds, and I mean that's not even on the level of tech investing.
Right.
I mean, 90 out of 100 fail, 95 out of 100 investments. So
yeah, well, but the rewards are a lot higher. So
yeah.
It's completely different. I mean, tech investing, to be honest with you, I can't even. I don't like to sell against, because tech investing is if something works, it's like you said, it's 1,000x. You can't compete with that. The average S&P investment in the marketplace, or if you look at an average S&P investment over a course of a 15-year period, you're talking about probably returns of anywhere between 10 to 15%, which is, paltry compared to what you can make in real estate and still have a ton of safety, because all real estate investments, including ours, is backed by the power of actually owning real assets. So over the course of 10 or 15 years in the same level of investing as you've invested in the marketplace, say you invested in a diversified fund in the S&P in the course of 10 or 15 years, that return of 10 to 15% would be easily triple with us. So over the course of 5 years with us, your investment could be worth 30% more than what you initially bought in with us. Over the course of 5 years in the S&P, it could be 25% or 20%, but it could also be minus 10%. So it really all. But if you take the averages, and I'm using the average over 15 years. We've been around for 10 years, so we haven't done 15 years. But if you take the averages of 15 years in the marketplace of 10 to 15% compared to what we have done in the past 10 years, it's easily triple to what the average investor is making on Wall Street.
Awesome. All right, well, I'm going to open it up for Q&A in a second. First, I want to ask you a couple random questions. One that Robert in the back threw on me on his podcast. Any person, dead or alive, you could go and have a drink with, who would that be and why? I want to see if it takes as long for him to answer as it did for me. I'm like, edit this down before it goes live, because I sat there for like 2 minutes. So.
Dead or alive? Let's see. That's a tough one.
That's what I said. I was like,
probably Richard Branson.
Nice.
Yeah. I admire the guy. He's built a juggernaut of an empire, and it'd be awesome to hang out with him.
Cool. Yeah. What's your tech prediction for the next biggest evolving market in the next, I would say, 10 years?
For tech?
Yeah, for tech. The big new thing.
VR.
Yeah.
Yeah, VR for sure.
Yeah.
I mean, it's the wave of the future.
Yeah.
We talked about it a little bit. I think it's going to have so many more applications in the next 10 years than just gaming, which is where it exists right now. Gaming and some educational aspect to it, but I think the application of VR is going to explode in the next 10 years.
Agreed.
People are looking at it now as a sort of a nuance of a newer technology, but I think it's going to be mainstream in 10 years.
Best advice you've ever gotten? It doesn't have to be to you personally. It could be a quote that you read on the internet, on Instagram. It doesn't matter. Best quote, advice.
Best advice? I think it's from my brother, but it's something that's on his desk. It's called. He's got a thing on his desk that says, "Dream big but work hard," and I think that's it's nice to dream, but no dream happens without work.
Without execution.
Without execution.
So we'll just go straight into Q&A.
Follow up on that one. What's the worst advice you've ever
That's what I was going to ask.
I like that. Worst advice? Trust me.
I have a better one, too. You talked about that entrepreneurial pressure crunch, and I kind of agree that there's almost that rush of approaching a deadline, knowing in your heart that you're going to hit it anyway. But as a leader, and with clients, with team members, with people relying on you, how have you adapted for yourself to try to change behavior so it's not always just at deadline time you're getting it done?
You got to delegate. You got to let go. It's something that I think my brother knows a lot more about, because he used to be a control freak a lot more than I was, and he had to. I think he will attest to that. Our business really grew when we started letting go of responsibilities and not being and trusting the team. I mean, you let go when you trust everybody else you work with, because if you don't trust them, then don't even hire them. I mean, or don't even work with them. There's no sense in doing that. I mean, if you're not hiring someone or bringing someone on your team that if after a certain time you look at them and say, you know what, I can walk away and trust that they're going to do what my vision is or what, you know, the vision of the company is, then just don't waste your time with them, because that's yeah, it's just a huge waste of time. I think once you have that, if you have the right team in place and you have the right execution in place and everybody's working towards the same vision, then you can probably relax and kind of pull back a little bit.
Excellent. What's his most embarrassing story? No, I'm just kidding.
Oh, he's got plenty of them. He's even got videos, like VHS videos.
This is why I intentionally put this out there. You're just drinking too slow to have.
I know.
I know this is kind of like a big issue right now going on in Charlotte. Like, what are your thoughts on gentrification? Do you think you guys should be taking care of it, or helping the people get reestablished in other places, or do you think the government should be taking care of it, or do you try to work with your current tenants whenever you take over?
As far as relocating, what? I'm sorry.
Like you come in and you were talking about earlier how the rent was cheap because management was not so great.
Right.
Right. So you come in on the rent, you work with your tenants and try to work around that.
Yeah. I mean, we do. And you got to look at the tenant profile when we first go into a build. We don't raise rents in areas that we go into where it's untenable for the tenant, because you're shooting yourself in the foot. I mean, your tenant are essentially your clients in a really large respect, are your clients. That's who we cater to. That's how we really succeed. I mean, if our tenants are delighted, then we're making, then we're making great strides. So, yeah, I mean, to a large extent, you can't win them all, though. I mean, you can't. If you increase rent by $30 a month and somebody can't afford it, sometimes we try to work with them. We do have other sister properties. Sometimes we say, look, if you can't afford to be here, then we have other sister properties that we can maybe relocate you to. Some of our managers try to work with them on getting any kind of federal subsidies if they need that, but that's, beyond that. I mean, at some point, if it's completely untenable, whether it's through relocating to other sister properties or getting federal subsidies or something like that, then that's pretty much where we can't do any more than that.
I'm a current student at UNC Charlotte, so I was wondering what were some of your best moves and some of your worst moves in college years at UNC Charlotte?
Best moves and worst moves.
Moves on girls, or what kind of moves are we talking about?
Moves? Moves. I had a lot of smooth moves back then. I thought they were smooth. Gosh, I don't know. I probably had a lot more bad moves when I was at UNCC than I did had good moves. And again, my brother will attest to him getting calls in the middle of the night.
We have the TV too for the videos of Gavin and Opie, so I can just pop those up.
Gosh, I think probably the good moves are picking subjects that I really was passionate about in college. As corny as that sounds, I mean, you really have to. You learn so much more when you're passionate about something that you're learning about than something that you completely could care less about. Those are my good moves. My bad moves are probably giving up too easily on a class that I probably should have stuck to more, and I paid for it when I was doing my master's. And, when I got my MBA, I was like, shit, I should have paid more attention in accounting. God dang it. So that that's probably it. Drinking probably didn't help. But
Makes the time go by quicker.
copious amount of drinking. Lots of drinking.
Cheers to that.
Cheers.
You're only limited to one question, sorry.
One more. So
Now go for it.
Just while we're on passion, I feel like passion starts when you're a kid. So out of curiosity, switching gears a good bit here, what was your first paying job, and what was it?
My first paying job?
When was it, and what was it?
Yeah. My first paying job, I was 13, 14. My father got me a job with this carpenter who was making, who manufactured cabinets and stuff like that. So my job was to sweep his shop floor and make sure the nails are picked up, and go with him on jobs to make sure that he's got his hammer and I mean, really, literally an old-fashioned carpenter. My second job from that was working with an AC guy. Again, my father got me a job with a guy who fixed HVAC equipment. So
That's where I took it. I know how hard that shit.
yeah, that shit was rank, man. So yeah, that's my second job. And it's, as far as learning from them, I mean, look, you learn from every job. It's I think my father's aim from getting me those jobs, as menial as they were, is just probably to teach me to, the value of work ethics and showing up. I had to be at the carpenter shop at crack of dawn sometimes, and at 13 or 14, we lived where I grew up in Syria. I grew up in Aleppo, Syria, and thinking back at it now, with my own son, I don't know if I'd ever trust him at 13 to venture out at 5 o'clock, 6 o'clock in the morning to go somewhere in a big city. I mean, this was not a small city, but he did, and I think I learned a lot of it.
Well, I think it's like that with a lot of people too, because now the stuff I was doing, running around town, riding bikes miles away at 11, I'm not letting my 11-year-old son do that.
Oh, absolutely, absolutely, yeah.
Just kind of like, obviously hindsight is 20/20, so like looking back at your career, I would assume like you obviously enjoy what you're doing, you're speaking to it. Would you say, looking back, would you have kind of left corporate America earlier, even though like the risk up front is greater as an entrepreneur, your quality of life is higher, or you enjoy it more, right? Do you
100%. 100%.
Would you have left earlier? Because I guess as somebody young in their career, there's always that idea of like paying your dues in corporate, like learning kind of the baseline and then going off. But I guess if the enjoyment is like so much higher, then why not just start as soon as you can?
Yeah, no, I probably would have definitely, if I was to change anything, and I'm not one with regret. I don't have regret. I don't believe in regret. I think regret is a waste of time. But if I was to change anything, it would be probably working less at corporate America and more on entrepreneur stuff.
Do you feel like they're just kind of going off that? Do you feel like there's some key skills that you like really need to learn?
Oh, yeah, absolutely.
At corporate America, and then you'd be like, hey, once I got these things, like I'm good to go. I'm ready for the next step.
Yeah, absolutely. There's a certain point that you get in your career if you're working in corporate America that there's a point of diminishing returns where it depends what you're going for and what kind of skill set you're going for, but there's a point of diminishing return, meaning at some point whatever you're learning is not bringing you any more benefit. So the benefits are actually receding rather than exceeding what you're doing. So when you get to that point, that's when you know you need to get out and do something else. And all of us will feel it at different times in our lives. For me, it was probably 3 or 4 years earlier than I should have. I felt it probably 3 or 4 years earlier than I should have acted on it.
It almost sounds like it's the same as being the smartest person in the room kind of thing. Like you're not learning anything anymore.
Yeah.
So,
I mean, when you get to a point where you sit across the table from someone and think, how the hell did they get their position?
You got Sean next. We got Igor next.
Do you think hardship develops scrappiness and grit, sometimes called? Do you think that gives an entrepreneur an advantage over someone who may have been hands?
Yeah, for sure. I think anybody, including Jeff, I think will attest that hardship definitely builds something. Grit is definitely it's funny that you use the word grit. I think that gets built over the course of experiencing both hardship and success. You have to have hardship and failure in order to really experience what success is. Failure is a huge kind of pet project of mine. I love the study of failure. I'm fascinated by failure. To me, to me, failure, knowing failure and studying failure and kind of, I don't want to say reveling in failure, but really, that's the ground zero of success. Because if you don't know how to fail, if you don't know what failing looks like, sounds like, tastes like, feels like, you're really not going to enjoy your success. You're not going to know what success is. So I don't know if that helps.
You mentioned the deals that you were making in your company from cash to $50 million. I was wondering what negotiation strategies have you used and what insights have you learned in terms of what works and what doesn't?
You have to be able to walk away from any deal, no matter how much you like it, no matter how much you think that it's the best things on sliced bread. You have to be able to walk away from almost any deal if it doesn't make sense to you. You got to draw the line, and you got to stick to that line. Obviously, you have to know when to walk away, and it's hard being an entrepreneur to know that, especially if it's your idea. But listen, you always can live to fight another day, but you can't fight the same fight for something that's going to lose you over and over and over again. So it's the same with our projects. We have to be able to after we do our assessments or we do our financial analysis, we have to have a point where we say, okay, beyond this, it really doesn't make sense physically, financially, doesn't make sense for us to buy this project, and we have to be able to walk away.
So I was just curious, John. So you mentioned you're about to raise the first fund. You also said that you believe you're close to the top of the cycle. Why is it timed that way?
You're always at the top of some cycle. So it's you're either the top of the bottom, or markets are always moving. So it's not timing the market per se as your time in the market a lot of times. So if we started the fund right now, which is what we're doing this month, our fund is going to be buying hopefully opportunities that are going to be held for the next 5 to 7 years inside that fund. If we are able to capture the right opportunities, meaning again going back to having the right financials, the right structure that we want for each deal, then the markets are not going to matter for us. I mean, there's going to be, would we maybe take the markets, if the markets take a 10 or 15% hit in the next 2 or 3 years, would it matter for us? Yeah, of course it'll matter for us, but that's the thing with apartment investing is we're buying something somewhat for longer, medium hold, 5 to 7 year hold, that if the financials are working right, then look, you're always gonna have renters. That's a fact. No matter how many houses are being bought, you're always gonna have renters. You're always gonna have demographics of people that are moving from jobs to different jobs, and these people are gonna need places to rent. So we wholeheartedly believe in the apartment business, and because of a little recapitulation in the market doesn't mean that we're going to stop renting apartments. Neither everybody else. So for those reasons, we think that launching a fund right now is just as good a timing as launching it last year or next year. And plus, it's our strategic vision is to launch. This is going to be the first of hopefully 3 or 4 funds to come. This is going to be Fund 1, Fund 2. If Fund 1 we're able to raise the money quickly enough. It's a teeny fund. It's not a big fund. It's a $25-30 million fund, so it's not really a big fund. We hope by next spring we'll be able to be in a position to raise Fund 2, and Fund 2 will be a lot bigger, or not a lot bigger, but bigger than Fund 1, and hopefully continue that cycle. I'm sorry. I was going to say by fund, let's say by Fund 3, which would follow hopefully the year after that. You're talking about between Fund 1 and Fund 3, you're talking about a total of anywhere between 10 to 12 year hold. And we can pretty much weather any financial cycles during that time of a 12 year cycle.
No, I was just going to ask, if you're doing a $25 million fund, 30 million, whatever the number is, and you're going to raise another one in 6 months,
Well, about, no, I would say 6 months, 8 months, 9
8
months,
months
yeah.
still.
Yeah.
How does that work with the LPs? Are you going to be able to do all your capital calls between now and then?
Yeah, well, I mean,
Well, I guess if you're doing 20 million,
well, the hope is, and knock on wood, if the first fund, if we finish raising it by, let's say, January, February, March of next year, then we'll know that it's closed. Obviously, we can't raise any more money. Then we'll have to be prepared with Fund 2 to follow right after that. So hopefully in May, June, July timeframe, we can look into launching Fund 2.
so if you invest in Fund 1, and this is just me being ignorant to this kind of stuff, I'm used to tech and other stuff. So if you raise Fund 1 and you have LPs in there, what are your LPs in Fund 2? Do you just do all your deals under Fund 1, close that, spend all that, and then you move on to Fund 2 and those LPs get the next deal?
Well, the LPs from Fund 1 combine to Fund 2. It's not, they don't have necessarily are closed out of Fund 2. Fund 1 is going to be focused on something very specific that Fund 2 is not probably going to be focused on.
Okay.
Fund 1 is going to be focused on smaller assets that we're going to buy that are under the institutional level assets. So Fund 1 is going to be focused on assets that are in the, let's call it $20 million max range.
Okay.
Fund 2, if it's as big as we're hoping, it's going to be hopefully $75 million, $80 million. Fund 2 will focus on bigger assets. So
Gotcha.
The returns will look somewhat similar, but the assets will be.
It's a different strategy.
It's a different
I might have a
strategy.
sweet spot. I want to be an LP. Okay, I like the vision of Fund 1. Fund
That's
2
right.
is a little too risky or whatever.
That's right. And Fund 1 is only going to be strictly multifamily. Fund
Gotcha.
2, or and maybe smaller office spaces. Fund 2 may have a lot more chunk of commercial office space.
Gotcha.
Fund 3 may have something else completely. May have at that point we may buy into something like a senior housing or student housing, which is another hot market, scorching hot market actually. Student housing is a hugely hot market right now.
Yeah. No, there was a consultant that I went and had drinks with a few weeks ago, and he was telling me the money he was making, and literally all he does is around the country is flies around and finds complexes within a 2-mile radius of major universities.
Yeah.
And he was telling me the commissions they were paying him just to be like, hey, there's this land available here. I'm like, really? Don't you have Zillow for that?
Yeah, no, absolutely. Yeah, student housing is huge and will continue to be huge just because the educational system is going to be cranking out so much more students than it could be. The universities are not keeping up with the amount of housing that's available to students out there. That's just the nature of the beast. I mean, there's a lot more student demand out there for housing than universities can supply.
Nice. Yeah. I mean,
With such a shortage of supply in the residential housing market, do you foresee apartments converting to condos? And if so, how will that affect your business?
It happens. I mean, it happens now sometimes where if it rarely happens that way though. It sometimes happens the other way where it's a condo that gets converted to apartments. Apartments are to us are a lot more cash flow positive than condos are. I mean, condos are you're doing a development from ground up, which we don't do. We don't do developments. We buy what's called stabilized assets, which are assets that are already built and cash flowing, per se. Condos are kind of a different animal, where you're depending on that housing cycle that I talked about earlier. Because condos essentially are like buying a home. I mean, you're depending on the actual home ownership for condo sales. I don't see a cycle to where that conversion is going to outdo apartments. Where people are going to own a lot more condo than they will rent apartments. I just don't see it, but I could be wrong. Yes, sir.
You guys looking at co-living at all?
What? I'm sorry?
You guys looking at co-living at all?
Co-living?
Yes.
I have not.
It's focused in, it's like a mini-scale version of an apartment complex that has large-scale shared community spaces for the residents to use. And it's a lot of short-term leases. You essentially buy a fully furnished, fully stocked room. Everything you need is there and supplied, and you have a community manager that essentially orchestrates all the residents to be part of this community niche that then goes and explores your city and does all these great things. So you're essentially buying into a community. And it's kind of a new sweeping the globe living arrangement model, mainly here at molecular transplants.
Oh, no, that's pretty cool. What do you think, bro?
Yeah.
That sounds pretty good.
You guys got some research to do tonight.
We've not done that, but that sounds pretty cool. I mean, it's there's a lot more. I could see there's a lot more logistically labor consuming because you have to that management process. You have to do so much more for the turns because there's a lot more turns. I read an article about I think what is it, HomeAway or one of those guys that are doing the short-term rentals are expanding tremendously in the next couple of years, where a lot of people are actually renting out their apartments to do the same thing as you're just describing. So I can see that happening. I can definitely see that happening. We haven't done any of it, but it'd be interesting to look into.
So with property acquisition, it's kind of like this. You're sort of torn between the cash flow numbers and your acquisition or your appreciation. And I know for single families, it's appreciation is a bigger factor. But for multifamilies, as you have apartments, is it more of a numbers game of cash flow? Is that when you're acquiring a property? Is that pretty much how it determines versus appreciation and the potential for?
Yeah, it's all cash flow. In multifamily, it's all about the cash flow. It's a lot less about appreciation of that.
Well, it's a lot less speculative than too.
Yeah, I mean, when you buy a home for yourself, just to make it to a more simplified term, if you buy a home for yourself, you care about what your neighborhood's going to do, what your city's going to do, what your town's going to do, so the value of your home will increase. You're not counting you're not saying, oh, how much am I paying in mortgage? That's going to determine the cost of my home. For us, we're how much we get in rent and how much we stay occupied, the percentage of occupancy in multifamily. That's really huge for us. The percentage of occupancy, obviously, everybody in the multifamily apartment business like to be over the 90% range, ideally over 95% range. And that dictates your net operating income, your NOI, and that in turn dictates the value of the asset itself. So the value of the assets is largely, I would say, almost 95% driven by the cash flow of the assets.
Excellent. I think we got time for one or two more questions. Justin, I'm surprised you don't have anything good.
Yes, everything.
Okay.
You're killing me, man.
I guess I could ask here locally, Carolina, Charlotte, are there specific markets that you're looking at to acquire more property?
Here in the Carolinas, we like kind of sleepy markets or sleepier sort of markets outside of the major metro areas. We like them just because we're value add, and we like to have markets that are an easily accessible distance to job centers, easily accessible distance to educational centers, health centers, but are not quite the price point of the major markets like South Park or Uptown. We love places like, Sugar Creek, yeah. And not so much Sugar Creek, but yeah.
There's great amenities. There's great amenities.
That's
there.
way too much value there. There's not enough value there. No, places like, for instance, like Rock Hill, South Carolina. That's a great market for us. Greensboro, Greenville, Cary. Yeah, exactly.
South Carolina Greenville?
No, South Carolina Greenville. Yeah, no, South Carolina Greenville. Yeah, not North Carolina Greenville. Sorry, South Carolina Greenville, Rock Hill, South Carolina. So.
Excellent.
I'm curious what you think about Asheville, if you look at that at all. I was just there last week. I know it historically has been sort of like a hippie town, but now it seems like there's a lot more money going into there. It's becoming more commercialized. I saw a few luxury apartment complexes being built. I see they're throwing a Whole Foods there. It looks like some people are putting that on Asheville. And
I think you've noticed it probably 5 years too late, because it's a booming market. It's a red hot market. Asheville is is actually so hot, it falls into that category I talked about earlier, where we're looking at the numbers and it just doesn't make sense to us because it's too expensive. It's a good long-term hold. So if we were to buy into Asheville, we'd want to hold it for 7-9 years plus in order for us to make our money, as opposed to holding it for our usual typical 3 to 5 years. So it just depends. I mean, those more expensive areas, like for instance, I'm from Boston, so if you look at places like Boston or New York or Manhattan, just because they're expensive doesn't mean that there are any buying opportunities. There are still buying opportunities. It's just that you're buying it for a lot longer term hold than you would be buying it in areas like here in the Southeast. You're buying properties in Boston. You're buying let's say a multifamily that's not even that big. Let's call it a quad, which is four different units. You buy a quad in Boston, you're spending about $1.2 million, maybe even more. Depends on the area. Well, in order for you to actually make the cash flow of that $1.2 million actually work for you and actually be able to get some upside on your investments, you have to hold it for probably close to 10 years, 8 years. It just depends. But if the market continues to be scorching hot in those areas, then sometimes you can turn around and sell it in 2 years. But you just can't depend on that. So that's why it's a lot easier to do value add sales and purchases in areas that are, I don't want to say more affordable, but the money is not, the money chasm between buying and cash flow is not as big.
So do you ever have to, I'm just curious, do you ever see an opportunity that you didn't necessarily describe to your investors, like that kind of falls outside of what you normally do? And did you ever, I guess you personally, maybe it was so good that you kind of had to sell the investors on doing this because you saw how good it was, like something that you saw really early that it's kind of hard to describe to, or that would just kind of take a while to sell because it's kind of outside of what you want to do? And if so, has that ever paid off?
We try not to, because if you do something outside of what you normally do, then you have a lot harder sell. It's a lot harder justification. You have to really be able to back it up with why you're doing something outside of the norm, outside of your expertise. It's a lot easier for me to sell something outside of their comfort zone than outside of my comfort zone. If I sell something outside of their comfort zone, but it's in my comfort zone, I will always win that argument. If I sell something outside of my comfort zone, I rarely win that argument.
Well, that's what they pay you to do, so that's why they invest in the fund.
Exactly.
All right. Any last questions? I know I said last questions. Wow. All right, well, cool.
Thank you.
No, this works
Thanks,
out well
guys.
because I need another drink. So
Yeah, exactly. I'm barely finishing mine.
Yeah, come on, hurry up.
I don't know. Cheers, guys. Thank you.
Thank you.
In today's fast-paced market, it has become more important than ever for small businesses of all different types to take advantage of today's technology in an effort to boost their business and reach out to customers. One of the best and most effective ways to do this is through video marketing. MACC Productions can help you and your company create quality videos that you can use as promotion tools for your business and bring in customers. The opportunities are virtually endless when it comes to video marketing options. The best part is these videos can work in nearly any industry or any niche. There is a great deal of untapped potential in the area of video marketing, and once we at MACC Productions help you create your video, it can be placed on your website and in all of your social media. That is like getting free advertising. Don't let your competitors pass you by. Contact MACC Productions today and let's get you started on one of the most effective marketing tools at your disposal. All at a price that is probably less than what you are paying for your current advertising formats. MACC Productions. Affordable video production for your business.